Shares of some of Canada's biggest oil companies took a hit today in early trading following U.S. President Donald Trump's interest in transforming Venezuela's oil-rich sector. And tonight there's worry about how these ongoing developments will impact our economy. Joining me now to explain is Martin Pelletier, Senior Portfolio Manager at Wellington Altus Private Council. Martin, good to speak with you.
You betcha.
First, can you explain for my viewers why what's happening between the U.S. and Venezuela matters to Canada and our economy?
Well, Venezuela is a direct competitor to Canada given the composition of the oil that they produce. It tends to be a heavier oil and a higher sulfur content. It just so happens to be a very similar quality that the refineries in the U.S. Gulf Coast can take. The irony in this was that due to neglect of their oil fields, production has fallen dramatically in Venezuela, and that's been a very positive thing for Canada as we've been able to displace Venezuelan crude going into those U.S. refineries, and that's been beneficial for us. Now, the concern is that if there is indeed a regime change that's more favorable towards oil development, bringing those barrels back on, those are less expensive barrels for refineries in the U.S. Gulf Coast. So there's a potential to displace the Canadian production that's now being refined there.
So should we see some shifts in global oil supply then, what sort of an impact would it have on gas prices or inflations here in Canada?
Well, not much on gasoline prices. I mean, if you're looking at in the near term, it's going to be oil prices are telling you not much of an impact from what happened on the weekend. There's going to take billions of dollars and of investment to restore the infrastructure in Venezuela and to increase their output once again. And there has been some early signs of an attractiveness or an ability to want to deploy some of that capital with the backstopping of the U.S. administration. That isn't going to impact gasoline prices even over the longer term. Maybe it does a little bit, but it all depends on how much the refiner profit margins in that U.S. Gulf Coast are going to pass along to the consumer. Where it does hurt Canada is if we start to lose those barrels, it starts to impact our fiscal balance. And what I mean by that is the federal government right now collects about $20 billion per year of taxes on these Canadian producers. In Alberta, on royalties, it's $34 billion a year. So this is quite material for the country. And if we lose 1 to 1.5 million barrels a day to Venezuela, as that displaces Canadian production or lowers the price that we receive, that means less dollars, less revenue dollars, which is much needed in these times in Canada, especially given the tariff threats that we're facing.
What could happen to our economy if the U.S. buys less Canadian oil then?
Well, as I just mentioned, look at the tax revenue that's going to be lost. The industry supports 400,000 jobs. You have a situation where BC is becoming more and more uninvestable given some of the situations we're seeing with the land claims. Ontario is in a real pickle given the tariffs are targeting segments of their economy, such as manufacturing and steel, that are really hurting them, and then the U.S. and the housing market rolling over. That leaves Alberta to carry the torch here, and Saskatchewan as well, and parts of BC. And if oil prices drop, they already have the last year, and if they continue to see pressure from additional barrels being brought on from Venezuela over the longer term, that's going to hurt our economy.
A lot of eyes on this, Martin. Thanks so much for weighing in tonight and sharing your thoughts.
You betcha. Take care.